Let's get straight to it. Loans are a part of life. They're woven into the fabric of our modern economy, influencing everything from our personal aspirations to the growth of entire industries. Understanding them isn't just about managing finances, it's about navigating the world we live in. Whether you want to buy a house, a place to call your own and build lasting memories, start a business, turning your passion into a thriving enterprise and creating jobs, or get a degree, investing in your future and unlocking new opportunities, chances are you'll need a loan. It's a common path, a stepping stone for many to achieve their goals. Most of us don't have locks sitting idle for big purchases. Saving up enough capital for a home, a business or higher education can take years, if not decades. Loans make those dreams possible, bridging the gap between aspiration and reality. They provide the necessary capital to kickstart ventures and build a better future. But they come with responsibility. It's crucial to approach them with careful consideration and a clear understanding of the terms and conditions. From home loans, which allow families to own property and build equity, to education loans, empowering students to pursue higher learning and career advancement, borrowing is how people, companies, and even governments fund their goals. It's a fundamental mechanism for economic growth and development. But here's the catch. It's not all sunshine and rainbows. If you don't understand how loans work, if you're not aware of the interest rates, repayment schedules, and potential penalties, you could make mistakes that haunt you for years. Debt can quickly spiral out of control if not managed responsibly. That's why we're breaking it all down, demystifying the world of loans and making it accessible to everyone. No jargon, just the essentials. We'll cut through the complexity and provide you with the core knowledge you need. We'll cover what loans are, defining the key terms and concepts, the main types, exploring the different categories of loans available and their specific purposes, and the risks you need to watch out for. We'll highlight the potential pitfalls and provide strategies for avoiding them. Because debt can be a tool for building wealth. When used strategically and responsibly, it can fuel investments and accelerate financial growth, or a trap. If mismanaged, it can lead to financial strain and long-term hardship. My goal? To empower you with the knowledge you need. To give you the knowledge to make smart, confident decisions. To navigate the world of loans with clarity and control. So if you're ready to take control of your financial future, let's dive in. Let's embark on this journey together and unlock the secrets to responsible borrowing. Grab your coffee, hit that like button, and let's get started. Your financial well-being is worth the investment of your time and attention. Loans are everywhere. They're a constant presence in our lives. Let's make sure you know how to handle them. Let's equip you with the skills and understanding to navigate them successfully. This isn't just about money, it's about so much more. It's about your life, it's about your dreams, your aspirations, and your overall well-being. Let's go. Let's get started on this journey to financial empowerment. So what exactly is a loan? It's a term we hear often, but do we truly understand its implications? Let's break it down in simple terms, demystifying the concept and exploring its various facets. At its core, a loan is borrowed money. It's a sum of funds provided by a lender to a borrower, with the explicit promise that the borrower will pay it back in the future. This repayment isn't just for the original amount borrowed, there's an added component. That added component is called interest. Think of interest as the cost of borrowing money. It's the lender's fee for providing you with the funds you need. The interest rate, usually expressed as a percentage, determines how much extra you'll pay back on top of the principal amount. The lender, usually a bank, a credit union, or another type of financial company, gives you cash up front, providing you with immediate access to funds you might not otherwise have. In return for this access to capital, you agree to their terms. These terms outline the repayment schedule, the interest rate, any associated fees, and the consequences of failing to repay the loan as agreed. It's crucial to remember that a loan is not a gift, it's a legally binding contract. Both the lender and the borrower have specific obligations and rights. Understanding these is paramount before entering into any loan agreement. Many different institutions can act as lenders. Traditional banks like HDFC or SBI are common sources for loans. Non-banking financial companies or NBFCs like Bajaj Finserv also offer a wide range of loan products. And let's not forget your credit card company. They too are lenders, extending you a line of credit that you repay with interest. The entire lending process hinges on trust, the lender's trust in your ability to repay the loan. To assess this, lenders meticulously check your credit score and income. These factors provide insights into your past borrowing behavior and your current financial stability. Based on this information, they decide if you're a reliable borrower, someone likely to fulfill their repayment obligations. A good credit score signals responsible financial management, which translates to better chances of loan approval. And not only approval, but also more favorable terms, like lower interest rates and reduced fees, saving you money over the life of the loan. Conversely, a bad credit score raises red flags, potentially leading to higher interest rates or even outright rejection of your loan application. Think of a loan as a tool, a financial instrument that can be used for various purposes. Like a hammer in a toolbox. Used wisely and responsibly, it helps you build a better future, achieve your goals, and create opportunities. But used carelessly, without proper planning and understanding, it can hurt you financially. Loans can be instrumental in helping you buy significant assets, like a home or a car. They can also provide the necessary capital to fund business startups, pursue higher education, or seize promising investment opportunities. However, misuse, such as borrowing more than you can afford, or failing to manage repayments effectively, inevitably leads to debt problems and financial stress. Therefore, the first and most crucial step is thoroughly understanding what you're signing up for, carefully reviewing all the terms and conditions. And equally important, knowing who you're borrowing from, researching the lender's reputation and ensuring they are a legitimate and trustworthy institution. Know the rules of the loan, understand the potential risks involved, and be fully aware of your responsibilities. Remember, every loan is a significant financial responsibility that should be taken seriously. Handle it right, manage it responsibly, and it can open doors to a brighter financial future. But handle it wrong, and it can unfortunately close those same doors, hindering your progress and creating financial hardship. When you're considering a loan, it's easy to get lost in the details, but at its core, every loan, regardless of size or purpose, has three key parts. Understanding these three components is crucial for making informed financial decisions. First, there's the principal. Then, there's the interest. And finally, the term. Principal is the initial amount you borrow. Simple. It's the foundation upon which the rest of the loan is built. Think of it as the seed from which your debt grows. Interest, on the other hand, is the fee you pay for borrowing that principal. It's the cost of having access to that money when you need it. Interest is usually expressed as a percentage of the principal. This percentage, known as the interest rate, determines how much extra you'll pay over the life of the loan. The lower the interest rate, the less you pay overall. Even a small difference in the interest rate can save you a significant amount of money in the long run. Term is how long you have to repay the loan. It's the duration of the loan agreement. The term could be as short as a year for some personal loans, or as long as 30 years for a home mortgage. Longer terms mean smaller monthly payments, making the loan seem more affordable at first glance. However, remember that longer terms also mean more total interest paid over the life of the loan. Your EMI, or equated monthly installment, is the fixed amount you pay each month, and it's calculated based on these three key factors: principal, interest, and term. In the early stages of the loan, a significant portion of your EMI goes towards paying off the interest. As you progress through the loan term, a larger portion of your EMI gradually shifts towards paying down the principal. For example, let's say you borrow RS5 locks at an interest rate of 10% per annum for a term of 5 years. Each month, your EMI payment covers both a portion of the principal you borrowed and the interest accrued on that principal. The longer you take to repay the loan, the more interest you'll accumulate, and consequently, the more you'll pay in total over the loan's lifetime. Therefore, it's crucial to always look at the full cost of the loan, including all interest payments, and not just the seemingly manageable monthly payment. Understanding these basic principles empowers you to see the real price of borrowing and make informed decisions that align with your financial goals. Don't just focus solely on the EMI amount presented to you. Take the time to calculate and truly understand what you're really paying over the entire loan term. That's how you avoid nasty surprises down the road and maintain control of your financial future. Let's talk about secured loans, mortgages, and auto loans. Secured loans are backed by collateral like your house or car. Mortgages are the biggest loans most people take, with long terms, 20 to 30 years. If you default, the bank can take your house. Because the risk is lower for the bank, interest rates are usually better. Auto loans work the same way, but for cars, terms are shorter, usually 3 to 7 years. If you stop paying, the bank repossesses your car. Cars lose value over time, so auto loan rates are a bit higher than mortgages, Both loans require careful planning. They're big commitments. Know what you're risking before you sign. Now, unsecured loans, student and personal loans. No collateral here. The bank relies on your credit and income. Higher risk for them means higher interest for you. Student loans help pay for education, often with a grace period before repayment starts. But interest can pile up during that time, so you might owe more than you borrowed. Personal loans are flexible. Use them for emergencies, weddings, or consolidating debt, but they're expensive and should be a last resort. The bank checks your credit score and income closely. Repayment terms are short, usually 1 to 5 years. Only borrow if you have a clear, realistic plan to pay it back. Credit cards, convenient but risky. Every swipe is a mini loan from the bank. Pay your full bill on time, and you pay 0 interest. But if you only pay the minimum, interest rates skyrocket, 24% to 48% per year. That's how people fall into the credit card trap. Debt grows fast, and soon you're paying more in interest than you spent. Compounding interest works against you, making it hard to escape. The smart move? Treat your credit card like a debit card. Use it for rewards or emergencies, but always pay the full balance before the due date. Miss a payment, and you're in one of the most expensive debts out there. Credit cards demand discipline. They're not free money, they're a costly loan if misused. Use with caution or risk financial pain. Loans come with real risks. High interest rates can double the cost of what you buy. Miss a payment, and you'll face penalties and a damaged credit score. That makes future borrowing harder and more expensive. The biggest danger? The debt trap. Borrowing more to pay off old loans. Soon, you're stuck in a cycle with all your income going to EMIs. Debt limits your choices, career, lifestyle, even your peace of mind. It's not just about money, it's about freedom. Before you borrow, ask, is this worth the risk and the long-term commitment? Sometimes the answer is yes, but you must be sure. Don't let debt control your life. Make every loan a conscious, informed decision. Want to borrow smart? Start with a budget. Only borrow what you truly need and can easily repay. Don't let banks tempt you with bigger loans. Compare offers, interest rates, fees, terms before choosing. Read every detail of the loan agreement, especially penalties and rate changes. Make the biggest down payment you can. It lowers your EMI and total interest. A solid down payment also shows lenders you're responsible. If possible, pay extra towards your loan whenever you can. Bonuses, side income, whatever helps. The faster you pay, the less interest you owe. Avoid prepayment penalties if you can. Borrowing isn't bad, but it demands discipline and planning. Be the master of your debt, not its victim. Every rupee you save on interest is a rupee you keep for your future. Borrow with a plan and you'll stay in control. Here's the bottom line. Loans are tools, not free money. Used wisely, they help you build a better life. Used carelessly, they bury you in stress. Know the principal, interest, and term before you sign anything. Shop for the best rates and never rush into a loan. Good debt builds assets or skills. Bad debt funds things that lose value. Every loan is a promise on your future income. Make sure it's worth it. Prioritize saving and investing over unnecessary borrowing. Stay informed, stay disciplined, and you'll use loans to your advantage. Financial freedom is about control. Don't give it away lightly. Thanks for watching, and here's to smart borrowing.